Do you know what the real secret to wealth is? They say once you master this secret, making money becomes effortless. And that secret? It's financial literacy. Every single self-made millionaire out there has one thing in common: they all understand these financial fundamentals. Today, I'm going to share with you 23 crucial financial truths that most people never learn. This is pure, unfiltered knowledge, broken down into 5 key sections: real estate, funds, insurance, currency, and the most important one, investing. By the end of this, you'll be so impressed you'll want to shout at your screen. Not only is this packed with valuable insights, but it'll also help you make smarter decisions with your money. Hit that like button, and let's dive into real estate. First, you've probably heard other finance channels say the housing market is a money reservoir. But here's the truth: it's not. The money spent on homes eventually flows back into the market. In reality, the housing market is more like a money printer. When people take out mortgages, it creates new money that floods the economy, leading to inflation. Second, a huge chunk of government revenue comes from land sales. If the housing market crashes, so does government funding. That money printer stops, and the economy could spiral into deflation. Third, buying a home might be the only time in your life you can borrow a massive amount at super low interest rates. It's also likely your biggest investment ever. Now, if your personal investment returns are higher than your mortgage rate, go for an equal monthly payment plan, and don't pay it off early. But if your long-term returns are lower than your mortgage rate, choose a decreasing payment plan, and still, don't pay early. Moving on to funds. Past performance of mutual funds doesn't predict future results. Don't get fooled by flashy historical returns. Fund dividends. Just a shell game, moving money from one pocket to another. Anyone trying to buy before a dividend to cash in is for a rude awakening. Over the long run, index funds are the safest bet for steady growth. When interest rates drop, bond funds benefit. When rates rise, they suffer. If money market fund yields are falling, it just means banks are swimming in cash. Stay away from leveraged funds unless you really know what you're doing. They can wipe you out. Now, insurance. Online policies with the same coverage are usually 30% cheaper than offline ones. Don't buy whole life insurance unless you're worth hundreds of millions. Never lie on your health disclosure. It'll only cause headaches when you file a claim. Get insurance first, then get checkups. Doing it the other way around might make you uninsurable. Coverage for 50 critical illnesses versus 100. The payout rates are almost the same. Don't overpay. A solid adult insurance plan includes critical illness, medical, life, and accident coverage. Annuities. Skip them, and avoid insurers with weak financials. They might go under before paying your claim. Currency basics. Raising interest rates makes loans more expensive, slowing down spending and inflation. Lowering rates does the opposite: more money in the market, boosting growth, but risking bubbles. The reserve ratio is how much banks must keep with the central bank. Increase it, and money tightens. Decrease it, and things loosen up. Every central bank needs collateral to print money, otherwise, no one trusts their currency. For the US, it's treasury bonds. For China, it's foreign reserves, mostly US bonds and dollars. If the exchange rate keeps dropping, people will swap local currency for dollars, draining reserves, which are crucial for money printing. That's why countries control foreign exchange. Now, investing. The rule of 72. Divide 72 by your annual return to see how long it takes to double your money. For example, at 9%, your money doubles in 8 years. Here's a trap: installment rates aren't real interest rates. A 12-month loan at 0.6% monthly, 7.2% yearly, actually costs around 13%. Just remember, installment rates are roughly double the real rate. Inflation's dirty secret: your real return is your nominal return minus inflation. If you earn 8% with 7% inflation, you're only up 1%. Beating inflation is hard, but doing nothing is worse. Your money becomes worthless. At 5% inflation over 30 years, money loses 80% of its value. Investing isn't just about getting rich, it's about not getting poorer. And if inflation's at 7% but loans cost 5%, borrowing to spend is actually smart. Now you see why financial literacy matters. Whether it's investing, buying insurance, or even shopping on credit. There are traps and opportunities everywhere. The more you know, the better you'll do. Make sure to hit that subscribe button, give this video a thumbs up, and share it with your friends and family. Thanks a bunch.